So this is our investment committee webinar for August. The agenda today, we want to give you guys a little bit of a market update. Then we want to cover some market news stories that have been interesting to us over the last month. Typically, we do have a guest, but since August, a lot of people are on vacation. It's been an interesting time in the market. We figured we'd focus more on the market stuff, and we'll have a guest for you guys next month. So it should be a little bit shorter. And then we also have a question and answer section. So if at any time you guys have questions, feel free to drop them in the chat and we will address them as soon as we can.
No rapport building or anything, Sean, just jumping right in.
Right to business.
Right to biz.
It's the
So first
summer.
thing we want to do is go over the market vitals for the year and the last month. So if we look at the S&P 500 over the last month, it's been a pretty moderate gain of just 1.3%. But it has not been without excitement. Heading into August, there was about a 10% drawback in the S&P 500. And over the preceding 2 weeks, the market rebounded right back up to where it was before that drop. So with volatility comes opportunity. We like to look at those types of drops constructively. As we're dollar cost averaging into equities when we see that drop. And we're also looking to target high yield structured note opportunities. So we welcome the volatility that we see and that we have seen in August. And August also is typically a slower trading month in the year. If you compare it to another month like March, it usually has 30% less trading volume than March, which can lead to a little bit more of those volatile swings like we've seen this year. So that's just something to take note of. If we look at the 10-year treasury rate in the last month, it's down about 9%. And there's a couple reasons for that. The inflation number has continued to inch down a little bit. It was at 2.9% year over year in the last inflation print. There's also been some fears of recession. So the unemployment rate has drifted a little bit higher. So the market is expecting that the Federal Reserve is going to cut rates in their next meeting in September because of that inflation rate inching down, because of the fears of the recession based on unemployment rates drifting up. So those are some of the factors that have led to this change in the Treasury rate. Another thing I want to highlight is just this S&P 500, NASDAQ 100 year-to-date performance in the upper teens up here. When we look at some of the other indices like the Dow Jones, the Russell 2000, which is a small cap index, and the Vanguard International Index, those are all sub 10%. So it's really been those large cap companies, those large cap technology companies carrying the torch for the market. What do you guys want to highlight? Did I miss anything? Is there anything that you guys want to kind of point out for what we've seen in the market, both year to date and in the last month?
Well, I think you mentioned the 10% pullback in the market. It was a little bit more severe for some of the titans that you were just talking about pulling forward. We definitely saw some selling there. We saw what some people might call rotation. But can you tell us a little bit, Sean, because I'm sure, people probably felt it, saw it on TV, but what ultimately do you feel caused that 10% decline?
They're gonna give me more homework. That's great. Okay.
Yeah, there's a couple reasons for the decline. Oh, sorry. I think that unemployment rate coming out was what really freaked people out, seeing unemployment drift from a low in the last 12 months of 3.9% up to 4.4% now. When you see that 0.5% increase in unemployment, that can typically be a sign that a recession is coming. So I think that was one of the main factors. There was also some volatility in the Japanese market with the yen carryover trade that kind of sparked some fears across global markets. So it was just a couple days stretch where there was a few data points that really spooked investors, and there wasn't that much carry through because some more data came out in early August that was showing that it wasn't as scary as we expected. So that's when we started to see that rebound begin to happen after that 10% drop in S&P.
So one of the jokes on Wall Street that used to throw around when something crazy would happen or just some out of the blue sell-off, one of the jokes would be, oh, a butterfly must have flapped its wings in Tokyo. And just kind of that ripple effect of small thing turns into big thing. And it just happens to be that pretty much a butterfly flapped its wings in Japan. and kind of caused a little bit of this the start of this panic. And I think it's always interesting to see how the market's motion actually causes the emotion on the investing public. It's like if the market's going up, people say, "Oh, things must be going well." When the market starts going down, and you start to get, because you mentioned the jobs report, some of the CPI reports, some of those other things that came out, some earnings and guidance, which was a little weak, people starting to move up the recession, and we'll talk about that in a second. But really, it started with the Bank of Japan raising interest rates and a carry trade starting to be undone, and then suddenly a couple people selling, and then everyone says, "What do they know that I don't know?" It's almost like if you're standing still and you're just kind of hanging out, and then you see a crowd of people running frantically and screaming in one direction, and immediately your panic, kind of instincts go up. You go, "Oh my God, what's happening?" And that's definitely, a little bit of what we saw there in that slow July, everyone just kind of hanging around, and suddenly there's a big sell-off, and people just went into full panic mode. Uh,
Yep.
so it's one of those things, and like you said, that kind of volatility that just comes with the market. That's just it. That's part of the deal,
Yep.
and it's not a bad ride if you can hang through that volatility. And as you were saying, it's even better if you can turn that volatility into opportunity. And we just think it's something you build into a strategy. It's not something to get upset about or shun. It's just build it into your game plan.
Yep.
What about you, Brando? What were you
Yeah.
thinking that stood out on this
Yeah, well, we have a
deck?
slide later on too, going through some of that volatility and looking at, the S&P performance, and then also looking at it, where are the declines happening, inside of each year. I think one also thing to note is the growth versus value table that we put in. That was something we put in on the last webinar too. And we really wanted to continue that and kind of point out the fact of, a lot of the times in the beginning of the year, we were hearing the rest of the market catching up from, small caps and values to those large tech companies. But we've really seen, growth really, still carrying the front here. And you can see the SP 500 growth being up 25% year to date, and outperforming, the S&P 500 value by, 14%. And even in that last month, nothing has really changed. And then similarly, if you kind of look down that, the large caps are, still outperforming small cap and mid cap. So really just the big point there is, being more observant, not necessarily predicting where the market's going to go, but, something to take note of is, watching that forward and, being able to make those adjustments and being a little flexible when you can, as, the environment changes a little bit.
Yeah, it's just not it's nonstop because that's been for 2 years
Yeah.
straight that this has
Yep.
kind of been the case. And I think a lot of people, they just like change and they want to see it change. And um yeah, it doesn't seem to become, but we got a question. Um, this question is, given that technology stocks are such drivers, what's your view, especially in the light of upcoming elections, if those big companies begin to see greater regulation, or do you think that there is a longer term horizon on that, regardless of who wins in November? Um, and then a secondary question of what do you think is going to happen in the election? The market has been pretty election agnostic, I would say. There was a little bit of rallying going on as the gap, when it was Trump and Biden. It seemed that the market was responding positively to the idea that, Trump was clearly in the lead. When Biden dropped off the ticket and we saw Kamala come on, I would say you kind of saw somewhat of equal. I don't know if it's played a big part in how the market's been trading. And believe it or not, even though it's right around the corner and we're hearing it on the news, I don't think it's playing too hard into people's investment strategies. I mean, I don't know if you guys feel a little bit different. We've seen a little bit of rally in some of the healthcare names recently. And I think it's hard to say that that doesn't have a little bit of a political affiliation to it.
Yep.
Well, especially since you can now say that Robert Kennedy is out of the mix, that probably helps healthcare. Just kidding.
Dynamite dropping, Bobby. Yeah, no, I
I
think
had to. I had to take it away from the two main candidates because political environments are, shaky.
Oh yeah, no, it's
Political
definitely
conversation.
it's gonna get really ugly, I think, in this election on some of the tit for tat and some of the mudslinging. But no, I don't, we've been saying for a while, you shouldn't really invest with your politics. It's not a great strategy. We don't really know any way to confidently, make money by guessing right or wrong on the election. So it is right now, if we just look at the odds of what the betting odds for the election, right now, Kamala is slightly in the lead. I believe last time I checked, it was about 57% favored to Kamala. And that I don't think is going to have too much of a change from the current kind of direction that things are going. When you look at the antitrust regulation and antitrust suits that have come up, and a lot of them have come up in Europe. Europe has been a little bit more aggressive than the US on antitrust towards large tech companies. It's kind of been a lot of wrist slap. It hasn't been any real when you think about like when Ma Bell was broken up by antitrust and some of the antitrust law that we saw in the 70s and 80s, that was really aggressive stuff. Nowadays, it really just seems like it's more emotion. I don't know if it's
Well,
going to be.
because those numbers are just insignificant in the grand scheme of things for a lot of these big companies. So they come through and it seems like a big number when you look at it just by itself. But when you compare it to the amount of revenue that they bring in, it ends up just like you said, wrist slap.
Yeah, and I think the real thing is money's one thing, injunction would be a very different story in antitrust. If they actually said that, you cannot operate as one company, if Amazon had to break up, its marketplace and its SaaS business, or its cloud business and any of that, if they actually had to break that up, what would the impact be? It would cause volatility. I don't know if in the case of Amazon, it would cause the price to go down. Some of these companies actually might have more value to unlock if they were separate entities in some places. But if it's just fines and things like that, I think, yeah, it's going to have a mild impact. But, our general view is until we kind of see it happen, there's been a lot of arguments that, these companies should be either broken up, they're too big, they're too influential, they've got too much power, but they're also some of the biggest political contributors. So
So,
I don't
Jordan, I
know.
have a question for you because when we talk about the political environment, I think exactly what you said is exactly what we tell everybody is you don't invest with your politics. But you're the mad scientist. I don't know if you remember off the top of your head the statistics of this, but whether the Democrats win or the Republicans win, it's more the certainty that's seen in the market that drives a positive outcome for the year. And I don't know if you want to weigh in just on the statistics of how that backs up, but I don't have those numbers in my back pocket.
Yeah, I don't have the numbers in my back pocket. I can tell you that, most of the time, if you look at, when is the market done better, Republican or Democrat? Don't forget that the entire tech bubble was under Clinton, and that really didn't have an enormous amount to do with politics. It had a lot just to do with the internet and, the enthusiasm that it spawned. So we always say that, kind of the business cycle and what's going on in the business world is going to be more impactful for how the market's going to move and where returns are going to come from. It's going to be more about that. The other thing to keep in mind, it's not just who's in the White House, it's who's in Congress. And if you really want to know what Wall Street likes best or what the market likes best, it's gridlock. It is the executive branch being one party and then Congress being another party and basically nothing happening. And this goes to kind of the question that was asked there about antitrust. When you have gridlock, you do not have, one party kind of dictating the regulatory environment. Democrats are usually considered to be a little bit more regulation based, a little bit more antitrust oriented. Republicans a little bit more free economy, a little bit less regulation. I don't know if that really is played out in a way where you can measure it by who's in office in the White House, because Congress usually has to go through and mirror that same attitude. So we haven't really seen an environment that has had a long lasting executive branch and Congress having the same political affiliation or having a clear, power control where they could really enact all their views. So,
Well, especially with people not really reaching across the aisle these days, it's been just that much more polar and that much more, I think, stagnant from a gridlock perspective. No?
yeah, no, for sure. And I mean, when you look at what some of the parties are really chasing after these days, it hasn't been, it's unfair that Apple is, charging so much on its on its app store, or that Amazon is taking 30% in its marketplace. It really hasn't dominated the news cycle as much as, some of the international conflicts and some of the, let's call it in school politics, and some of the political things that are just a little bit more in people's face on a day-to-day basis seems to be driving more of the political outrage. And it seems that Congress and the candidates today are responding more to that. There's another question that was just asked. Year to date, returns on growth are well ahead of value. Do you see that holding true over the next quarter? Just again, as Brandon kind of said, we do not like to make big predictions because, we just like to be observant and see how things are shifting. We did see a little bit of a rotation during that decline that Sean was talking about before, that 10% decline. We did see small caps outperforming a little bit right before that decline started to gain momentum. Before it was a recession kind of fear, and it was just looked like a little bit of quarterly window dressing. It then kind of got a little spooked. And in that environment, we did see for a second, though, value start to take a little bit of a lead there. Value is expected when interest rates drop. Value is expected to benefit a little bit more. Small companies tend to be a little bit more economically sensitive than some of the larger growth companies. They tend to have margins that are a little lower. Lower borrowing rates are definitely healthier. Value companies tend to have a little bit more debt. So lower rates, again, they can go and refinance and get better numbers. So it kind of makes sense in a lowering rate environment that is going to help value companies fundamentally more than it will help growth companies. But what you tend to also see in that environment is as interest rates go down, people tend to go and buy more speculative stocks where the earnings is further out in the future and the discount rate that they apply is going to be slightly lower. That's a complicated kind of topic, but pretty much when rates go down, people tend to like to buy speculative companies. So I think it will help all parts of the market because the gap in value and growth has been so big for so long. There's a lot of people arguing that small caps will have a huge rally more than growth companies on the heels of rate cuts. So we'll see when it happens, but a lot of people are anticipating that. And I wouldn't be shocked if it did end up happening, but I don't, will it actually outperform growth? Yeah, good reason for it. I don't know. We'll see. I really, I think it's good for stocks no matter what. And I think, it's good to have a little bit of both probably at this stage. I think, we're starting to add a little bit more value components, and part of it's just, because we've been overweight growth for a while, and we just think it makes a little bit more sense to get back more towards the middle at this stage in the cycle. So whether it's right or wrong, tune in next month.
All right, let's touch on some recent news stories that we've seen over the last month. Something that we saw yesterday, AMD buys ZT Systems for about $5 billion. So ZT Systems is focused on data center solutions and improving AI capabilities. So we've seen NVIDIA has been running a bit of a monopoly on the data centers, the AI. If we just look over the last 1 year, NVIDIA is up 190%, which is just insane.
Is that good?
It's pretty good. AMD's up 52%. So AMD is no slouch, but they're looking at NVIDIA and they're seeing that explosive growth and they're starting to try to emulate that blueprint. They want to start trying to challenge NVIDIA on those data centers, those AI capabilities. So it's going to be interesting. AMD is kind of that second in line to NVIDIA when you look at the semiconductor space. So it's just something to take note of. Will other chip makers try to follow suit? Is NVIDIA just going to continue its dominance? I think competition is good for the industry in general. It leads to more business efficiencies, more innovation. I think it leads to just broader sector growth when more companies are trying to build each other up. So I think it's a positive, but what do you guys think in terms of whether this is going to be healthy competition, whether AMD can kind of catch up to NVIDIA and start to do some of the same things? Should be interesting.
Yeah, I mean, I think one thing, like you kind of mentioned, is who else is following suit. And then I think something else, that could be interesting is what other companies are looking to buy, either smaller companies that are doing some of the data center things, or if like a new company comes up, are they gonna, grow, or is someone gonna try and buy them and build them into their own, kind of ecosystem? And how does that all play together? And, who are going to be the big players there?
One thing to note when we're talking about AMD versus NVIDIA, and I think this is still one of those things that my jaw drops every time I take a look at it. But NVIDIA's net margin, its gross margin is 75%. Its net margin, as of the last report, is 53.4%, which is nuts. AMD, by contrast, is about 6% net margin. That's a big difference. So you talked a little bit about competition. I think competition is usually what erodes people's margins. And right now, NVIDIA's kind of been playing without a competitor. And I guess, that kind of, which way would you anticipate, Sean, Brandon, whoever wants to field it, which way do you think it's going to go? Do you think that NVIDIA is going to kind of come down back to earth and end up having a little bit of a lower margin, more like, the 11 to 15% we typically see for the average company? Or do you think that this is an opportunity for AMD to kind of, move its margin up, and maybe some other companies, by making moves like this, having more software and more bundled packaging, are they going to end up seeing some margin expansion? What do you guys think?
Yeah, that's a great question. I think we're probably going to see some movement in both directions. I think it's going to be hard for NVIDIA to continue to see those 70% margins when more chip makers are starting to try to do the same things that they're doing. And likewise, AMD, if they're breaking into this new data center solutions part of the semiconductor market, I would expect that they're going to start to see some of the benefits that NVIDIA is seeing. So I think that gap will begin to close, and I think it's going to be kind of a movement in both directions. NVIDIA is going to start to normalize a little bit. I think AMD is going to start to see a little bit of an increase as they're entering more of this data center centric part of the semiconductor world.
That answer was way too logical and balanced. Come on, Brandon, give me something wild.
I was actually going to say the exact same thing. I mean, I think I can come with a hot take if need be, but I think that's probably the most, logical thing, is that it kind of works in both directions for those two companies. And then, also with anyone else, if they're trying to almost copy that blueprint.
Yeah.
Yeah, it'll be interesting to see if like Intel begins to do something similar. Like AMD and NVIDIA get a lot of their semiconductors from Taiwan. Intel, I think, is a little bit more domestically based. So it'll be interesting to see if a company like Intel starts to kind of invest more into the data center solutions business.
Intel's net margin right now is 2%.
It's not great.
No, they've got some work to do.
Yeah, definitely.
Let's move on to our good friends at Goldman Sachs, Jan Hatzius.
So this just came out yesterday. Goldman Sachs cut their recession odds over the next 12 months to 20%. So before this, it was at about 25%. And the cut was, well, there's been recession fears, specifically based on the July data that we kind of discussed earlier, something called the SOM rule, which is the 3-month unemployment rate average after the July data was released, was about 0.5 percentage higher than that 12-month low. So the 12-month low is 3.9%. Over the last 3 months, the average has been about 4.4. So that half percentage point higher typically is a sign of recession. So that's part of what caused that 10% decline in the S&P 500 to start August. And as we've had some new numbers come out, retail sales, jobless claims, there's been really no signs of recession in that data. Also, CPI continuing to inch down, which is leading investors to believe that the Fed is going to cut rates. Some of those recession fears have begun to ease a little bit. And that's what we're seeing here with Goldman reducing that down to 20%. So it makes sense based off the numbers we're seeing. There was a jump from the unemployment rate, but there's been some strong data since that indicates that there's not an imminent recession on the way.
Yeah, just a quick full round trip. Before the July data that, threw a little bit of tension in, Goldman actually had recession risk at about 15%. After that July data and after the market started going down, they raised it to 25%. And now they just, dropped it back down to 20%. So they've been the most active. They're also relatively bullish on the street. When you think about where they have recession risk, if you go to our friends over at JP Morgan, Jamie Dimon and friends, they're closer to 35% currently at their probability of a recession. They also saw the unwind of the carry trade. They had expected it to be much, much deeper and much, much uglier. So, which one of them is right? Is 20%, is 30%? That kind of is like a normal walking down the street kind of range right there. Like, what's the chance of a recession at any point in time if I just, you fell into a coma and woke up and I was like, what do you think the chance of a recession is right now? And you were like 20 to 30%. I'd be like, good answer.
Yeah.
So I think that it's not anything to get too excited about, but once again, this kind of shows you how much Wall Street kind of jiggles and moves around on small numbers where it's really not that exciting. Let's keep moving.
Yeah.
Got a timetable to keep here.
Yeah, so here's a chart. There's a lot kind of going on here, so I just want to spend a second explaining it.
Just a little bit, Brandon.
Could have been better worded. So it's the S&P performance from 1990 to 2014, and you can see the performance.
You mean 2024.
2024, sorry. And then you can see the individual performance or returns each year. And then the average return of the S&P from this time frame is about 10%. And then the red dots are the market drawdowns with the largest market drawdowns within that year. And then, the dotted line below that is the just average drawdown throughout that period. So I think there's a few important notes to make from here. So there's only about 9 years where there were negative returns in this data set. And typically when you see that, the next year after has had, pretty good returns. So even looking at 2022, we saw it down about 19%. And the next year, 2023, the S&P being up around 24. Same with, 2018. Obviously with 2000 to 2002, there was a couple years in a row, the S&P being down. And I also think going back to, what we said earlier, on the first slide of what happened at the end of July, early August, you can see that in a lot of these years, there's, a 6% drawdown or 10%, but the overall returns of the year are still pretty good. And, just for example, 2012, it going down 10%, but that year being up 13. And something that you've probably heard Jordan say a lot during calls is, taking the stairs down and managing volatility, and then, taking the elevator up and really looking at those as, opportunities and what are we doing from there? If that's, putting extra cash to work or, where can we see some of those opportunities with, whether that be structured notes or if something, did have a decline, is now a good time to be buying that and really looking at it as an opportunity. And then also, having that short-term mindset versus long-term. Obviously, the long-term over this, data set, the S&P is up about 10%. But obviously, if you just look at it on a specific day, and there is a lot of volatility or, in that week, it might be, a little bit scarier if you're just reading some of those headline news, but making sure you still have that long-term investment horizon, and you're making sure, am I still on track for my goals, even though there is a short spout of volatility?
Yep.
So 9 out of 35, by the way. So that's about 25%.
Okay.
So that's a little lower than, what you see in some other historical data. But I think we should also remember central banks have been a lot more active during this period of time than they were in, call it the 100 years before 1890 to 1990. We didn't even have Federal Reserve during the Great Depression, and that was like an 8-year chunk of negative returns after the 1920s. So it's a pretty good run, but I'm actually pretty shocked how low some of those red dots are, even when you had a strong positive year.
Mm-hmm.
Yeah. You can see this 8% intra-year drawdown that we've had this year, 8 to 10% in August. It's pretty typical if you look at the years prior. There's very few years where there's not an 8 to 10% drawdown. So it's kind of a par for the course, seeing something like that at some point during the year. And it's just important to look at that as an opportunity to take advantage of markets.
Yeah, for sure. Great chart. Lot going on. On.
This is something that we got from Russell Investments. So they did a study of 31 recessions from the years of 1889 to 2022. 31 recessions, 16 of those recessions actually ended up having positive market returns, and 15 of them had negative market returns. So this chart is just comparing the returns of the market during expansion periods with the returns of the market during some of those recessionary periods. Really just want to highlight, look at these recession numbers. About half the time during a recession, the market returns positive with an average return of about 9.8%. In those negative recession times, down about 15%. But when you look at that whole subset, when the market is in a recession, you would expect it to be a lot worse than this down 3.3%. A lot of times people hear recession, they think, oh, the market is going to go down. They think of the financial crisis of 2008. They think of the tech bubble in 2001. But when you really evaluate the data, not all the time is the market taking these huge hits. It tends to be pretty resilient, and half the time it ends up even being positive. So that's just something that we wanted to highlight. Even if that 20% happens, there is a recession in the next 12 months. It's not going to be an imminent 30% drop. Obviously, that is a possibility. But looking at the data, it tends to be a little bit more balanced than that.
So one of the things that's really crazy about this, and this is kind of like floating in the data, as we look through. This is 154 years of data. That's a lot. And in that, it's basically said that when the economy is expanding, that's been 110%, 110 or 111, let's just call it, out of the 154. That's about 72% of the time. The market, the GDP of the world is going up, or the GDP of the United States is going up. And 43 out of those 154, GDP has been going down, and it is qualified as a recession using like the NBER, National Bureau of Economic Research, their kind of definition of what a recession is. But what's kind of even more nuts is you talk about the positives, because sometimes the market has predicted a recession, then a recession happens, and it actually starts to recover during that period of time. So some of those positive recession return times, it's like, do you care if you're in a recession or not? Or do you care more about whether the market's going up or not? And I think what's kind of crazy here is if you look at that negative recession return number, all right, it's minus 15. And if you look at the negative years when we're in an expansion and we have a negative year, it's negative 25%. So what that kind of shows you is that when we're in a recession, when markets are already low, when general feelings are already pretty negative, there's not too much more to go down. What's actually a little bit scary is when people get a little bit euphoric and they think everything's great and they completely forget about risk. And then suddenly the winds change suddenly to scare people, like what happened in August. And that's actually when you have, harder downdrafts. And so you kind of have to manage the expectation of 70 to 75% of the time, things are pretty good. But people, the market is going to scare you or shake out the weak hands. And you just have to decide, you know, if you're going to be a strong hand during that period, or if you just don't want to play. And I think that's really kind of the two options as we like to talk about. And that's when we try to cater for people's risk. That's really what we're trying to do. It's, are you going to look at those opportunities as opportunities, or are those things going to make you scared? And then we have to kind of craft something that makes sense for those times. But those negative years can come before recession even is on the horizon. And so that's something to keep in mind. You know, you can be right about recession and totally wrong about market returns. And that's kind of what makes this stuff tough. But as Brandon said, if you're observant and you react with logic, with reason, and with a longer term plan, you can really benefit from it. And I think that's the thing that we always just try to emphasize.
Yep. I think it kind of goes back to the market like certainty. When the fear of recession is looming, that's when there's a lot of volatility. When it's certain that we're in a recession and the market's already down 20 to 30%, that's when some of those positive recession outcomes can happen, like Jordan said.
Yeah, I'm just looking at so actually the number of years where GDP was expanding is 111, and the number of years where the market was going up is only about 96. So out of this 154 years. So even though we were in economic expansion 72% of the time, the market only went up 62% of the time during this period. If you measured it by years, right? Number of years as opposed to you know, actual time. So I mean, you know, what does that mean? I don't know. What it means is people are more negative than the economy actually is. Does that sound like a shock?
All right, that's all the content we have for you guys. We'll stop sharing the presentation. Feel free to drop any questions in the chat if you have any.
Yeah, if anyone has any questions, we'll just stay on for another couple minutes, or you know, as questions come in, obviously we'll stay on longer. But how are we feeling? How do we feel about the Olympics? The Olympics are over. How do we feel about it? Do we feel like America gave a good show? Are we all going to start breakdancing in our spare time? And what do we think?
I'm getting into handball.
Handball?
We've talked about this. Yeah. I think that'd be great.
I agree.
And we won all the medals as America. So
We did do pretty well medals wise, I think.
we won
I
the
want to
most.
watch some more of the ping pong action. I think I could maybe pick up a few tips.
That the ping pong I think was actually the most fun to watch.
Yeah.
I really I did feel like that was the best stuff they had out there.
Good techniques.
All right, it's looking like not seeing any more questions come in. So we will be live again next month. So keep an eye out for the registration link for next month's webinar. We will have a guest for the next one. We look forward to talking to you guys then.
Yeah, if anyone has any questions, or you know, just want to kind of, you know, maybe you're, you know, getting things ready and you know, just kind of hanging around your house listening. If you have any questions though, if there are things kind of percolating in your mind, obviously elections coming up. We definitely have a little bit of a different view on how the candidates are kind of presenting the current state of the United States and the economy. And you know, that's politics, and that's what it's always going to be. We do think that there's reason to be a little bit more optimistic about where the economy is right now, where things are going. You know, we're hearing a lot of caution. I think that's good when you hear caution. So, but if you have questions, you know, if you're listening to some of the stuff and you know, or you're reading stuff in the newspaper or whatever else, and you know, you just want to gut check it and be like, you know, are you guys thinking about this, or is this something I should be worried about, or is this just, you know, kind of political fodder that's you know, getting thrown about? Just shoot us an email, you know, shoot us a text, shoot us, you know, better to just ask and get it off your chest than kind of, you know, let your anxiety grow from it. So I just encourage people to you know, do that whenever you're feeling a little antsy. There's no reason to have to wait and worry.
Yep.
All right, I think we're good to go. Well, thanks everyone for joining. Thanks for logging in. Hopefully everyone's enjoying their summer, and we look forward to speaking to everyone soon.
Take care, everybody.